UOB and OCBC announced fantastic Q3 results for the financial year of 2024, which sent UOB share price up 10%, while OCBC share price up 7%. So in this video, let us go through their results and see why their income is still increasing even though interest rates are coming down. For UOB, they have the potential for huge growth in non-interest income due to the expansion and integration of consumer business they have purchased from Citibank. With the increasing non-interest income, UOB would not have to worry about the potential decline in interest rate by the Fed. So let's go through the result to see how they are performing. Straight off at their key highlights, total profit is up 10% Q over Q, while fee income is up 2% Q over Q. One of the best results, similar to other two banks, was their trading and investment income. For UOB, it came in at a huge growth of 77% Q over Q, while 82% year over year. Trading income will always be a fluctuating factor, but the good news is that it was also supported by all-time high customer flow treasury income. Non-performing loan and CET1 ratio is decent, with the CET1 ratio at a very good level of 15.5%. Return of equity, which is a very important parameter for banks' profitability, went up by 1% quarter over quarter from 13.3% to 14.3%. This is good news because this meant that UOB actually generated more income more efficiently this quarter. Looking at their balance sheet, net interest income increased slightly by 2% Q over Q, which is supported by the higher amount of loans taken. The difference maker was their non-interest income, which is the fee income and the other non-interest income. Fee income grew by 2% and 10% year over year is a decent growth, while the other non-interest income came in at 63% higher quarter over quarter, which we'll see why later. This led to higher net profit of 13% quarter over quarter, which is good because this potentially means higher dividends, and in the earnings call, they have mentioned about considering share buybacks, which is also similar to DBS. So if we look at their net interest margin breakdown, loan margin continues to increase to 2.56% and slightly increase in the bearings asset for this quarter. Therefore, this resulted in a growth of 2% quarter over quarter for their net interest income. This is impressive considering the fact that interest rate is coming down. Moreover, as interest rate drops, they can easily offset the drop by cutting saving banks' deposit interest to offset it. Similar to the net interest income, fee income continues to increase 2% quarter over quarter. Like I always said, this part of the business will continue to grow as UOB gets more customers from the Citibank's businesses. The highlight of this quarter again was the huge jump in the income by 77% quarter over quarter. The management mentioned that it was due to the all-time high customer flow and good results from the trading and liquidity management. This is one factor that will drive the growth of all Singapore banks, with Singapore being a reliable country that will attract wealthy individuals and companies to put their money in reliable banks. Another important parameter to watch for banks is their cost-to-income ratio. It's an indicator showing the cost efficiency of the bank. For UOB, if we exclude the one-off expense, it comes in at 41.5%. But because of the integration from the Citi consumer business is still undergoing, there is additional costs incurred, resulting in higher cost-to-income ratio at 42.4%. However, good thing is that it's sloping down and will soon stabilize, which will definitely benefit UOB. This ratio is higher than both OCBC and DBS. But if it helps to fuel the growth of the company, then this level of spending is acceptable. No changes to their non-performing loan at 1.5%, which is a very safe level for banks' international standards. Similar to DBS, with the international standard Basel III reforms implemented, UOB's CET1 ratio went up to 15.5%. This is good because this meant that the banks will have more capitals that can return to shareholders or grow the company. As shareholders, it's very important that companies are willing to reward the shareholders by either increasing the dividends or do share buybacks when they have a lot of capital. With the income growing, the potential for dividend growth is definitely possible because banks usually do dividend payouts at 50 to 60% of their total income. Moreover, in the earnings call, they have mentioned about the excess capital and considering the option of doing share buybacks similar to DBS. This might be one of the reasons why it has caused the share price to shoot up. With the recent rise in the share price, the dividend yield will be around 4.9%. Even though it is lower than REITs currently, investors who buy will be expecting their dividends to continue to grow years down the road. Next, let us go on to OCBC Earnings. Looking at their key highlights, group net profit increased by 9% year over year, which is good, with total income increasing by 11%. Net interest income dropped 1% year over year, while non-interest income increased by 41% year over year. Similar to DBS and UOB, OCBC's non-interest income has been performing well, which will potentially allow the bank to declare higher dividends in the upcoming quarters. Return of equity came in at 14.1%, which is lower than the reported of 14.5% for last quarter's results. Out of all the banks, OCBC came in slightly disappointing because of this drop in the ROE percent. Net interest margin dropped from 2.2% to 2.18%, and this is expected as interest rate drops. However, customer loans increased 4% year over year, which helps to offset the drop in margin. That is why their net interest income only dropped by 1% year over year. Non-performing loans ratio is at a low of 0.9%, and similar to the other two banks, CET1 ratio increased to 17.2% due to the Basel III reforms. If we look at their breakdowns, net interest income and fee income is still increasing slightly at 1% quarter over quarter. Wealth management is the one that is boosting OCBC earnings, with asset under management increasing 2% quarter over quarter, with the wealth income increasing 2% quarter over quarter and 15% year over year. This was driven due to capital inflows from customer into OCBC, and I expect this trend to continue for the three banks for the next few quarters. With Great Eastern being mostly purchased over by OCBC, they will need to perform well as well. This quarter, they managed to continue their good run with increase in income of 72% year over year and 4% quarter over quarter. The net interest margin has been dropping for OCBC, but like the management said before, as the amount of loans taken increases, it helps to offset the drop in margin. This can be seen from the 9 months of 2024 results, and that is why it still managed to register a small increase of 2% year over year. A lot of people assume that with the interest rate drops, banks will definitely lose money in net interest income, which is not always the case. Investors need to understand that they have multiple ways to offset the drop in interest rates. Non-interest income was up 41% year over year, and this quarter's growth was thanks to the increase in trading income and net fees. This is fantastic as this portion of the income will play an important part in driving up OCBC's profits and, of course, dividends. Wealth management is also something to focus on as more money flows into Singapore banks. Wealth management's fee increased by 16% quarter over quarter and 25% year over year. Based on the earnings call, I expect the wealth management to continue growing healthily. Cost to income for OCBC comes in higher at 38.5%. However, the higher expenses was due to business activities and groups digitalization. This is good because this improves the efficiency of the businesses in the long run. Thanks to the good performances, OCBC current share price will give a dividend of about 5.5%. However, like UOB, if they can maintain the profit growth, I feel that they will definitely increase their dividends. Overall, we can see the three banks' performance for this quarter. DBS is the biggest bank out of the three with total income of 5.7 billion compared to UOB and OCBC of 3.8 billion. Net interest margin wise, DBS is the best out of the three at 2.83%, while UOB is at 2.05% and OCBC is at 2.18%. This is partially why DBS ROE is at a higher level of 18.8% compared to UOB's and OCBC of 14.3% and 14.1% respectively. All the three banks are doing well growing their non-interest income, with DBS having the highest portion at 37% of the total income. With interest rate coming down slowly, It's important that the banks grow the non-interest income so that it will ensure that their dividends to shareholders can continue to grow. Non-performing loans for all three banks are at a very safe level. CET1 ratios indicates how much the capital has. All three banks are at a very high level, with the DBS management mentioning that 12% would be a decent level. That is why DBS have announced share buyback program where they will spend 3 billion buying back their own shares. UOB is also considering share buyback program, and that is why both stocks' share prices went up by 10%. OCBC is the unique one, as they mentioned that rather than doing share buybacks, they will increase their dividends. At the current levels of the CET1 ratio, hopefully OCBC will be able to announce a special dividend. Even though all three banks' share prices have recently went up after earnings, their dividend yield might be at an attractive rate considering the fact that they might increase their dividends. If you have enjoyed my video so far and want to open your brokerage account to start investing with promotions, you can use my affiliate links below. Thank you so much for watching. Please hit the like, subscribe, and comment on your thoughts on the bank's results. You can watch my previous analysis on the banks or the recent analysis on Mapletree REITs. Thank you, and I'll see you in the next video.